Is U.S. bond rating soon to be downgraded? Why a 5.25% Fed funds rate still can't shrink inflation expectations and CPI. The U.S. government is officially living paycheck to paycheck. The Congressional Budget Office just said U.S. Treasury is running out of cash soon. So, is the United States still a safe bet? For decades, it has been. U.S. Treasury securities represent the world's largest bond market. It supports retirement plans and corporate balance sheets and investment accounts everywhere. In times of turbulence, investors flock to treasuries because they're viewed as a surefire way to protect your money. However, Standard & Poor's downgraded the U.S. credit rating by one notch the last time. There was a serious debt ceiling showdown. In 2011, when the government came within hours of defaulting on some of its debt obligations, U.S. consumer sentiment plummets to a 6-month low. For we're in another debt ceiling standoff. People are worried if the government runs out of cash that it will trigger a recession. University of Michigan's survey on Friday also showed consumers' long-term inflation expectations jumping this month to their highest reading since 2011. Why U.S. credit rating is soon to be downgraded. Why a 5% Fed funds rate still can't shrink inflation expectations. I will explain it all right after this.
How you like that? How you like that? Look at you, now look at me. Look at you.
Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video. Because you're already a success, it is done once you join the Audacious Money Witch Club. This video is brought to you by my website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? Congress is playing chicken with the debt ceiling. Bank analyst Christopher Whalen said, "We think the amount of the U.S. debt already demands a credit downgrade. Just the increase in debt service costs is enough reason for ratings action." When S&P downgraded the U.S. credit rating in 2011, for the first time ever, it cited fiscal and political problems. President Obama signed a bill raising the federal borrowing limit on August 2nd of that year, just hours before the Treasury would have run out of money, forcing it to default of some payments. S&P found the bill Obama signed unsatisfying. 3 days later, it lowered its U.S. credit rating from AAA to AA+, with a negative outlook, meaning further downgrades could occur. S&P said the political brinkmanship of recent months highlights what we see as America's governance and policymaking becoming less stable, less effective, and less predictable than what we previously believed. 12 years later, the U.S. fiscal position is objectively worse. The national debt has exploded from $15 trillion in 2011 to more than $31 trillion today, as a percentage of GDP total federal debt. has ballooned from 65% in 2011 to 95%. The Congressional Budget Office forecasts that will rise to 132% 10 years from now. That's around the same time Medicare and Social Security will start to run short of money. As a result of Fed hiked rates by 5 percentage points during the past year, one of the fastest hiking cycles in history. U.S. borrowing costs are soaring. In 2011, interest payments on all U.S. debt totaled an amount of $425 billion. In 2022, interest payments hit $710 billion. In the first quarter of 2023, interest payments hit $929 billion. On an annualized basis, the United States now spends as much on interest payments as it does on defense. The S&P 500 stock index nearly fell 7% on the first trading day, after S&P's 2011 downgrade, cementing a month-long 15% drop in the market, triggered by the whole debt ceiling fiasco. The University of Michigan survey on Friday also showed 5-year inflation expectations rise from 3% to 3.2%, the highest reading since 2011. Bad news for the Federal Reserve after it signaled last week that it could pause the fastest monetary policy tightening cycle since the 1980s. This report has a bit of a stagflationary feel to it. This increase in inflation expectations is likely to add a spirited discussion about whether to hold or hike again at the June 14th meeting. The survey's preliminary reading on the index of consumer sentiment came in at 57.7 this month, the lowest reading since last November. Its measure of consumer expectations dropped to 53.4 from 60.5 in the prior month. If policymakers fail to resolve the debt ceiling crisis, these dismal views over the economy will exacerbate the dire economic consequences of default. The Congressional Budget Office warned on Friday that the nation faced a significant risk of defaulting on payments, obligations within the first 2 weeks of June, without a debt ceiling increase. Import prices rose 0.4% last month. Imported fuel prices increased 4.5% in April, driven by a 5.7% jump in petroleum prices. The cost of imported foods rose 0.2%. Which brings us to monetary policy because the CPI came down a mere 0.1%, annualized 4.9% versus 5% from March to April. However, markets were bid on belief that this CPI print will ensure a Fed pause. If the Fed pauses here, then it's very likely that inflation will reaccelerate, because that's what happened in 2008. However, markets went into meltdown mode, which caused inflation to collapse. It's also what happened to Volcker in 1980, and he was forced to raise rates even faster later in the year. In either scenario, markets will implode sooner or later. Rate hikes of 5% still have not brought inflation down under control. Why? Because the Fed's balance sheet is 95% correlated to the CPI. And lately it's been rising again to counter the incipient banking meltdown. This balance sheet is the epicenter of the Fed's policy error dating from 2020 until now. It increased 100% during the lockdown. And it has only come down 5% since the Fed has started tightening. It is the sole source of monetary inflation. Only an idiot assumes a 1.5% reduction in interest rates. In March 2020 caused a 40-year high inflation, especially now that rates are 3 times higher since the pre-lockdown. Hence, that is the fatal consensus, and that is totally unquestioned. Which gets us to big tech domination in stock market. This S&P 500 tech rally is all because of AI craziness. According to CNBC, there is a 50% chance AI will wipe out all of humanity. But that's not going to stop them. Bulls have already forgotten that the big techs were at the epicenter of the 2021 big bubble. They've forgotten about the pull forward of investment in cloud, e-commerce, and chips, so everyone could work from home. Maybe AI can magically save a sector that has an earnings decline of 10% year over year. One can only hope that Terminators only live in Hollywood. Here is my book, Believe You Are Worthy. Such an amazing book. Order your copy today. You are such a good boy for watching my video right till the end. Bye.